I'll say thank you very much for the opportunity to share a few thoughts with you. Also in terms of the economy and the consumer. It's the consumer that buys residential property and also the property investment market. Just before I start with the presentation, I think it's most appropriate to say a few words about what has happened earlier this week in Britain. It was actually a great shock to the financial world, specifically in terms of what has happened there. The expectation was that Britain would elect to stay within the EU. Obviously, it did not happen that way, and the financial markets actually expected that it will be a vote for stay in the EU. It had a massive shock on the financial markets. The stock markets in Asia, which opened first during every day, around about 3 o'clock, 4 o'clock in the morning, our time, they depreciated and weakened quite strongly, 6, 7, 8% in many instances. After that, South Africa opened and our stock market dropped by between 4, 5 up to 7% at some stage. Then Europe up to 8% plus, and into the US last night I had a look, up to 4, 5%. So it had a massive negative effect on equity investments. And together with that, the exchange rates immediately reacted in the early hours. Our rand exchange rate shortly after 12 o'clock on Friday morning, 12 o'clock midnight after that, it was sitting at 14 rand 33 to the US dollar. And shortly after that and into the early mornings, around about 7 o'clock, 8 o'clock, 9 o'clock, it was sitting at 15 rand 60. And it came back to 15 rand 23, 24, down to 14 rand 88, back to 15 rand 20, and late last night it was relatively stable around 15 rand 05, 06. So a lot of volatility around what has happened, and everybody was thinking, how is it going to impact our country, even if we are far away from that part of the world? How will it impact my specific country? And it all comes down to the trade relationships between, say, South Africa and that part of the world, and Britain specifically. The UK is our 5th largest trading partner for many years, so it is important, these things, and it seems like that the trade negotiations and trade relationships will have to be renegotiated, even from our perspective. And although it has created a lot of uncertainty in the markets, and I believe that uncertainty will be there for some time, it is a structural shift in the UK, and these things will not go away over the short term. But what is a bit concerning, if you read what other countries in Europe and in the EU are currently saying. France has said they also want a referendum now to stay or to exit. The same is in the Netherlands, and Scotland has said they want to stay in the EU, so they want a second referendum shortly. So these things are really serious, and it can impact your financial markets even further, and contribute to further instability and volatility. So there's a lot of uncertainty against that background. In the end, it will most probably influence our country to a much lesser extent than the countries in the EU area specifically, but eventually it can have an impact. We are an emerging market country, we cannot deny that. Our markets are much more volatile, equity market and exchange rate, forex market, much more volatile. than some other countries and parts of the world. So we will be influenced because of that specific reason by these developments. But it is early days at this stage. One will have to see how these things play out in that part of the world and how it will impact the rest of the world and the global economy in total. The concern is that countries will now pull back in terms and look inward, more protectionist in terms of their own financial and economic situations. We know that the world economy is not really performing very well at this stage. So there is that concern that economic growth can pull back. And it seems like that the central banks around the world now, Bank of Japan has got major economic problems. They have to stimulate their economy big time. China is pulling back. The United States have started increasing interest rates late last year, but the economy is up and down all the time. In Europe, things are not that healthy in terms of the economic performance. So all these factors play a role, and it seems like that the central banks will now have to come up with some concerted stimulation to the world economy. Otherwise, what has happened now in Britain can spread to other countries, the same type of situation, and it will be bad for the European environment and the European economy. Europe and the European economy and that region, in terms of a region, it is our biggest trading partner region in the world from a South African perspective. We cannot deny that, although our trade with the East, especially China and India, has increased quite a lot over the last number of years. Europe as a region, extremely important to us. So we will have to take cognizance of what is going on there, and we'll have to monitor quite closely what are developing there, what is developing there, and the possible impact of these developments on our own economy. But let's leave it there. It's still early days, a lot of uncertainty and instability still. We will see how these things develop over time. But it seems like, at least from our exchange rate point of view, that the rand was much more stable towards the end of Friday, into Friday evening, Friday night. So we hope that it will be much more stable moving forward. But the rand has depreciated quite a lot and has been very volatile during the course of yesterday. And I think from this point onwards, we can expect most probably a weaker exchange rate that we've seen recently because of these reasons and developments and the impact of these developments on developing economies, including ourselves. So in terms of the economy, what I will do is I'll touch on two slides, one on the economy, one on the consumer environment, and the rest will focus on the property investment issues, various issues. There are a lot of information and data and stuff in the presentation. I've arranged that the presentation can be distributed afterwards. There's nothing confidential in there, so you can use it, you can look at it, and for whatever purpose you want to use it. So it will be available for distribution. So to look at the contents, I look at the economic trends of residential property investment indicators, and then in just sort of a summary in terms of what I believe the most important key factors and market factors and investment factors that investors should take into account. I've also have some notes that I've made. If I can't remember anything, in the end, age catches up with you. You have to refer to some of your notes in the end. So to look at the economic trends, and from that graph at the top left, one can see what has happened to economic growth. Gross domestic product, that is the total domestic production of the country, and the growth in that, how it has actually deteriorated over time. 2009 obviously was a recession, and after that an improvement, recovery in the economy, but a gradual downward trend in economic growth up until the first quarter of this year, where we've seen the economy contracting by around about 1.2%. That is a very serious situation. Now, you must have heard the term recession in the past. Now, the way we define a recession, a technical definition, is 2 consecutive quarters of a contraction in the economy. So if the economy contracts again in the second quarter of 2016, it is most probably a recession in the economy. And I believe we are on the edge there. It is a very fine balancing act at this stage. We are almost towards the end of the second quarter, and we will only have the second quarter data for the economy as a whole around about September. So it's always a lag of about a quarter. But this downward trend was to a large extent driven by these factors: low global economic growth and demand that impact our economy in terms of a demand for our exports, also low commodity prices. We are a commodity exporter in terms of a lot of metals and minerals. We also have tight fiscal conditions. The government finances very much under pressure in terms of a slower growing economy, obviously, then lower levels of revenue, lower levels of tax income, while the expenditure side is still there. It is very difficult to cut expenditure over a broad front. So the government finances very much under pressure with lower levels of revenue and tax income, while there's still a lot of pressure, upward pressure on expenditure. And then obviously the drought. We had a massive drought during last year into 2016. And maybe it has rained in some areas, but that impact of the drought last year is continuing into many food producing areas and regions, still have a massive impact on those areas. And obviously that will feed through to inflation and food prices, but I will touch on that as well. And all of these factors, low global economic growth, low domestic demand for goods and services, tight financial conditions in terms of government finances. Government has started to increase tax rates in recent years, increasing the tax burden on the consumer. The drought conditions, all of these led to low levels of confidence. And I'll show in the next slide a graph in terms of the levels of confidence in the economy. So the economic performance not very strong. And then we are sitting with an increase in inflation as well. This graph here at the bottom, one can see that red line. What has happened to inflation? Although it is peaked recently and on a slightly downward trend, but there are still mounting inflationary pressures. If I look at fuel prices, there's again an under recovery on average during the month of June in terms of fuel prices, which means that fuel prices will again increase in the early stages of next month, which will put further pressure on the consumer, further pressure on costs in businesses, which will be fed through back to the consumer. So inflation is on an upward trend, which caused interest rates to rise in the end. So the main factors that are driving inflation currently is the rand exchange rate that is on a depreciating trend. Food prices, because of the drought conditions, you can't control the exchange rate and food prices, and also fuel prices with domestic interest rates. Electricity tariffs are increasing by above inflation every year. That adds to inflation. Property rates and taxes increasing every year, in many instances more than inflation, and also wage demands of above inflation, which is what one can understand that, because your consumer comes under pressure and they ask for a higher wage increase and salary increase at the company where he works. For example, in the vehicle industry, they will go into their negotiations shortly, within the next month or so. And it seems like the indications are that they are going to ask for a 20% wage increase. Not to say that it will be granted in the end, but that is the starting point. And it means that the negotiations will most probably be extremely difficult in that specific sector of the economy. And one can understand that. Your consumer is under pressure. already, and it's coming increasingly under pressure because of these issues. And employment is not growing. Unemployment is 26.7% in the first quarter of this year, which is much higher than 23-24% that we've seen in previous years. Not that that 24 was that much low compared to where 26.7% is currently, but it is an increasing trend, and that is a bit concerning. So, against this background, what do we see moving forward? Obviously, the situation in Britain has turned a lot of things upside down in terms of forecasts. Currently, our forecast is for economic growth to be almost zero this year, 0.2%. And the lead that we get from that is from the leading business cycle indicator, where the Reserve Bank takes a lot of variables in the economy that they believe are leading indicators in terms of where the economy is going. They combine them scientifically into a single index, and that index is on a declining trend right through 2014, 2015, into the first 4-5 months of 2016. And what that index tells you is that for the next 6 to 9 months, the direction of economic activity is most probably downwards. So that is not really good news, but that is reality. I always say I don't try to be overly pessimistic or overly optimistic. I'd rather be realistic and give you the facts. And one can work from that and say, this is where we are, what does it mean moving forward? And within these challenges, obviously, there are always a lot of opportunities as well. But let's leave it there. In terms of the Rand exchange rate, the forecast 16.50 by the end of this year. It's sitting at just over 15 at this stage. Taking account of what has happened in Britain this past week, it is quite possible that that exchange rate can be higher, nearer to 17 or just over 17 by the end of the year. And this will feed back into inflation. As I've said there, one of the inflation factors is the Rand exchange rate. It makes it more expensive to import oil, for example, which is one of our biggest import products, to refine, to come to fuel in the end. And that is why fuel prices are increasing. A depreciating exchange rate, together with that, an increase in the oil price. Although the oil price came down a little bit, about 5% yesterday, but it is stabilizing around $46, $47 per barrel from the just above 50. But it will most probably stabilize there, and then as things calm down, it will start to move up again. So against that background of an exchange rate that we expect will depreciate further, inflation factors, we expect CPI inflation, consumer price inflation, of almost 8% by the end of next year, of this year. So what will happen to interest rates? The Reserve Bank will have to look at this situation in terms of upward pressure on inflation, and we expect that red line to pick up even further. It means that interest rates will have to increase further. And the big challenge for the Reserve Bank under these conditions is that the economy is moving into a state of stagflation. Now, what does that mean? It means that the economic growth is stagnating, and 0.2% is not really economic growth. That is virtually zero. You can't call that growth. So a stagnating economy while inflation is picking up. That is where the term stagflation is coming from. So what do you do as a central bank with interest rates? I believe it is a massive challenge. And then we know what has happened recently in terms of the rating agencies, the credit rating agencies. They kept our rating stable. Even the outlook on our situation, they kept stable. But they warned us there are a lot of issues that you have to look at. Unemployment is a problem. Your economic growth is far too low. You'll have to look at economic policy measures, uncertainty around that. You'll have to look at those issues. And what they actually said, in fact, we give you another 6 months. By the end of this year, we'll come back and we will review your economy. We will review your government finances, your economic policy, everything, and then we'll take a decision. So the risk of a credit downgrade is still there. And if that happens, we will drop into that sort of position of below investment grade, which means that many portfolio managers and other countries in the world will not be able to invest in certain assets in the country because their mandate for investment tells them that they can only invest in countries with an investment grade credit rating, not junk status as they call it. And that will have a massive impact on our exchange rate, for example, because there will be capital outflows because of those mandates, or there can be capital outflows. A further depreciation in the exchange rate, what will happen to inflation? One of the driving factors of inflation is the exchange rate. Inflation can increase further, which means that the Reserve Bank will hike interest rates further. What will happen to the economy? I believe the economy will go into recession. So these things are quite serious, and we'll have to avert a credit downgrade at all costs. But I think that is enough on the economy. We know what are the trends, we know what are the challenges, and we know that the Reserve Bank is in an extremely tight spot in terms of monetary policy. Let's look at the consumer environment. One slide with 4 graphs. Let's start at the top there. There one can see what has happened with consumption growth, consumption expenditure, and income growth. Income growth is the red bar, consumption growth is the grey bar there, a downward trend there in that growth, taking into account what has happened to in the recession. And for the first time since the recession, first quarter again this year, we've seen a drop in income growth. Consumption in the economy from a consumer perspective actually contracted. And there's a close relationship between income and expenditure. It's because savings are relatively low. Now it seems like that there are some nice upward trends here, but if you look at the scale to the left, it's very small. The average over this period from 2005 to 2015 is around about 1.5%. Savings, 1.5% of disposable income, which means if you have a 100 Rand, or the consumer out there has a 100 Rand disposable income available, after taxes and pension deductions, all of that, they've got 100 Rand at their disposal to spend. They save only 1 Rand 50 of that. That is what that 1.5% means. They only save 1 Rand 50. Now that is virtually nothing. What is also interesting here from this graph, in times of economic difficulty, like in 2008, 2009, when we had a recession, savings are growing. Now how is that possible, that savings can grow in difficult economic times? And we are experiencing the same year in 14, 15, and most probably into 2016. It is because savings is the answer between income minus consumption. So if consumption contracts, there is little bit more that you save. It's very little that you find, and I don't think it's common that you find in difficult economic times that the company says, okay, fine, you're earning so much per month, but we're going to cut your salary next month by 5%. No. Income normally can either increase at a very slow rate during that period because of economic difficulties that also impact the company, or your salary stays the same, but it's very seldom that your salary is cut, not that it is impossible. So the difference between income and consumption is saving, and that is why it increased, but only increased, say, from, well, it was there below in 2007, below 0.5%, but the economy was still growing there, look there. And it was still growing, and the consumption and income growth was still there. But into 2007, 2008, it came to lower levels, and that is why it increased. But there's another line on that graph. It's the relationship with household finances with economic growth. And one can see how that correlation actually performed. Now, why is that? It's because the consumer contributes more than 60% to economic growth in the country. So 60% of gross domestic product, the total production in the country, is driven by household consumption. So if the consumer doesn't consume, you will see it in economic growth. So it is a consumer-driven economy to a large extent. And that is very important. In the end, your consumer is extremely important from any business point of view. If you are selling vehicles, if you are selling mortgage loans in our business, extremely important. That's what we focus on every day, selling mortgage loans to our customers. But if the customer is not in a good financial position, savings are low, you will see it in the economy in the end. So what has happened to debt situation? The debt ratio, that is the ratio of outstanding household debt to his disposable income. That ratio has improved over time. So less debt in relation to income. But why is that? It's because the consumer came under increased financial pressure. One can see it here in growth. So that came as no surprise. And also the NCA, the National Credit Act, was imposed in 2007, which also made credit lending much more strict. So that had an impact on the debt ratio. So the debt ratio improved gradually, but it is still relatively high at around about 77%, 78% at this stage. But the other concerning factor here is the impact of interest rates on servicing debt. But, in other words, your interest component in terms of debt. And that has started to increase. The moment your interest rate pick up, debt repayments increase because of the interest component of those debt repayments. So here one can see that the consumer is coming under pressure. So what does this mean for the economy as well if you stand back in terms of confidence? Confidence levels have declined quite a lot. Not only in the consumer space, but also in the business space. The black line here. The consumer is closely related to the business sector. Very closely related. Except in 2010, what happened there? The economy was recovering after the 2009 and another big event in 2010. Can you still remember? Absolutely. Had a massive positive effect on consumer confidence. And it also boosted business confidence a little bit. After that, it waned quite quickly and that downward trend continued. So confidence, extremely important in any economy. Also referring back to what is happening with your consumption patterns. Not only in terms of income, but eventually your confidence will impact consumption patterns, will have an impact on the demand for credit, and it will work through back into your economic growth. So this is the consumer picture at this stage. Very high level, income and consumption growth, savings, impact on economic growth, the debt situation, obviously very important. If you have too much debt, you can't take up further credit and you can't consume and buy nice luxury items and all of that, and it will be reflected in the economic growth. So confidence, I believe, has become a more important factor in the broader economic environment and the performance of the economy than in years when confidence was at a high level. And very few business people and companies actually took notice of confidence in those years. But obviously, confidence is much more important. You will find maybe many households are financially strong and they are sound. But if they don't have the confidence in terms of what is going to happen to the economy and their own finances, uncertainty of what is happening in other parts of the world and how it can impact us, they will not consume, they will not take up credit, and it will be reflected in your broader economic environment. So confidence, I believe, has become much more important. So let's forget about the economy and the consumer now. Let's move on to what has happened in the property market. First, residential price trends. Strong growth in the mid-2000s, declining trend there, still positive, and then we went into a recession year, 2008, 2009, pick up after that, but house price growth didn't really pick up to the levels that we've seen in the past. Against that background of increased financial pressure on consumers, declining economic growth, declining consumer and business confidence. In the end, also had an impact on the property market. And if you look at the two lines there, the one is nominal growth, the other one is real growth. Real growth we calculate by excluding the inflation factor from price trends. And why we do that? It is sort of a more technical type of calculation. It's because as an investor, you would like to know if your property investment is increasing and appreciating at a rate faster than inflation. So you want, it's the same with your salary. If inflation is 6% or whatever, you want at least a 10% salary increase so that you feel your wealth is growing, you're doing better than inflation. It's the same with property prices. And unfortunately, the nominal price growth was around about 5% since 2008 up until the first quarter of this year. But in real terms, after you take out inflation, property prices was actually on a declining trend of around about 1%. Not a massive downward trend or contraction, but at least it is still there. And I believe it had an impact on the percentage of investors buying buy to let. There can be some other reasons here as well relating to yields. Because your yield, and I'll touch on the yield issue a little bit later, yields in terms of property investment is currently lower than the cost of capital. If you take the prime rate, it's 10.5%. I don't think property yields are sitting at that level or even above that at this stage. In terms of some regional trends, obviously there will be major differences in the regions, and I've looked at 4 metro areas here, and together with the country in total. There are massive differences, but within these trends, there are certain segments of housing that can be either growing very strongly or growing poorly at that stage, and then these trends are just a combination of that. But then one must also take into account these metro areas are not exactly the same. There are different area and regional related factors that are driving these areas and price trends in these areas. So you cannot always compare them directly with each other, but it's just to give you some view of what we've experienced in the past 3 years into the first quarter of this year. Now, the outlook. We expect price growth to remain relatively low. It's currently 5.7% as we've measured in the first quarter of this year. We're looking at 5% on average for the year as a whole. What does that mean? It means that towards the end of the year, price growth will most probably have to drop lower than the 5.7% to come to the 5% in nominal terms average for the country as a whole, against the background of what is happening in the economy and the consumer sector. And I must really say the risk for price growth is still to the downside, so it can be even lower than this, which means that with inflation picking up, and we're looking at inflation of around about 7% on average for the year, that in real terms, that is after that inflation calculation, that the house prices can drop by 2%. Now, it is not all bad news from a property perspective point of view. If you want to invest further in property, it just tells you that prices are not going to run away. It's most probably not a bad opportunity to get into a property investment from a price perspective. But then I should advise you, in terms of your investment horizon, I'll touch on that right at the end. Your investment horizon should be a little bit longer than usual, maybe 5 years plus, and especially in terms of capital appreciation on your investment. So don't expect to make a huge profit in terms of capital growth within the first year or two. It's most probably not going to happen, looking what has happened here. And obviously, these trends had an impact on how your investors perceive property investment in recent years. And it hasn't collapsed in total, but it's obviously at a total different level compared to what we've seen in the past. But then, at that stage, property price growth was much higher. And one must expect, with property price growth at a very high level in certain stages, that you will have a lot of more investors and even speculators active in the market because they see where prices are going and they can make a quick buck over a short term. By now, 3, 4, 5 or 6 months down the line, they sell and they put 200,000 in the pocket or whatever. That situation has changed completely. And most probably a lot of investors and speculators specifically have left the property market in terms of investment. So these are most probably your more serious, longer term property investors that were active in the market over those years. So against this background, what has happened in terms of demand and supply? And this is done research by TPN, that is your tenant profile network. It is a credit bureau institution that looks at especially the rental environment in residential but also commercial. And what is interesting here, that in their fourth quarter survey, the perceptions from investors was that there was a strong demand for rental property, but only an average supply. And that obviously will have an impact in the end on price trends. And one can see that in further sort of data series, that this is actually a problem. Strong demand, but only average supply. Now, the demand and supply in terms of rental stock is normally in your flats and townhouse environment, not really in your big 500 square meter single stand properties. Obviously, there are investors that are investing in those type of properties as well, but the focus is to a large extent in your flat and townhouse environment. So this is quite interesting, and I believe this is reflected in your building statistics, your building activity of flats and townhouses over recent years. Look what has happened in the mid to somewhat later 2000s. We had the recession, downward trend, massive downward trend in building activity in flats and townhouses, the residential side. Some pick up, but not nearly back to the levels that we've seen in those years. Despite economic growth, low interest rates. Interest rates dropped by, I can't remember, from wherever into 2010, quite sharply. And what is building activity done? Not really performed. But again, remember what we said about and what we looked at in terms of the consumer financial trends. What has happened to confidence over these years? Downward trend, consumer under increasing financial pressure. So the demand for property, still there, but the supply was impacted. And one can see here, in terms of building confidence, that is from your building sector, architects, all those professions and industries in the building industry, developers, contractors, subcontractors, retailers of building materials are all included in this calculation here. An upward trend there, but not really breaking that neutrality line of 50, which tells you if it's at 50% of the sector is positive in terms of confidence, and the other 50% is negative. And it has been on a declining trend recently. Your residential building activity actually reflected to some extent what has happened in the economy and in the consumer environment. But because of this low growth, this is why we've seen this. The demand for that is there, but the supply isn't there. The confidence in the building sector wasn't there to support that strong demand. So, in terms of price trends, that can also have an impact on your building environment. Price growth not really there. Developers say, is it really worthwhile developing if I can't really bring property to the market that will sell quickly and I can make a good profit? In terms of rental value bands, also stuff research by TPN, quite interesting is your value bands, that 81% of tenants rent in the area of 3,000 or below 3,000 up to 7,000. That is where the big demand for rental property is. And obviously, towards the upper end, it will get smaller. You know, not a lot of people can afford 25,000 plus per month. So the focus is really towards the lower end. And that is a thing that the property investor should keep in mind if you want to invest in property. You can go to the upper end, but it will most probably take longer to rent out your property. The market segment there is much smaller. What is also interesting in terms of these value bands is that the vacancy rates, here at the bottom, it's about 15%, 15.4% is the vacancy below 3,000. There it is about 14%, just over 14%. And the one just below that, that is the 12 to 25,000, it's about 13% vacancy rate. Here in the middle, it is 6%, 6.1%. So again, the vacancy rate might be a little bit higher, and that is where a relatively large percentage of tenants focus, but the lowest vacancy rates in these two categories. In terms of payment behavior, this is the average for the country. 85% of tenants are in good standing, meaning that they are up to date with their rental payments, paying every month when they should pay. The middle, these three middle bands are actually having the biggest or the highest percentage in good standing. 86.2%, 88.4% and 85.4%. Very much in line with the national average, although two of them slightly above that. Quite interesting, towards the lower end, much lower paid on time, lower in good standing, but also the upper end. That is quite interesting. Above 25,000. Actually the poorest performance. And if you look at that, actually the biggest risk from a property investor point of view. But then one must remember it's a relatively high rental. If there are any issue in terms of income or whatever, that tenant will most probably or can fall behind. And credit affordability or rental affordability and credit issues and credit records and all of that can play a role here. So it seems like from these statistics that right at the bottom and right at the top, those are your two risk areas. Well, again, it shows you that this sort of lower but more the middle segment market, that is where the focus for investment property should be on average or in general. So quite interesting trends here. In terms of the national trends, 69% of tenants are paying on time, and then the others follow. But some pay late and some never pay and all of that. This percentage can change from time to time. In your difficult times, difficult economic times, one would see that this percentage paying on time will most probably come back a little bit and then improve again as things improve. And here's actually a long-term graph of how this has performed. And here in 2008, 2009, the percentage paying on time or remaining in good standing dropped quite sharply. And it just shows you how sensitive your tenant segment is for the broader economic environment and economic trends. We had a recession during this period. So obviously, this was expected and came as no surprise, but quite a sharp drop there. And then that gradual improvement as the economy improves. But what is interesting again, it seems like that it is leveling out. Again, against the background of an economy not performing that strong anymore, consumer sector coming increasingly under pressure, and it impacts your repayment behavior in the end. In terms of 3 provinces here that I've extracted, Free State, Gauteng, and KZN, very much in line with the national average, especially Gauteng. The other 2's a little bit below. So paid on time, still the biggest percentage, but paid late, a relatively sizable percentage there, and also partial payments, just to show how things can actually differ between certain areas. But these trends are extremely important to give a sort of a high-level view of where we were in the past, what were the consequences and conditions there, how it is improved, but what is happening in current times over the past couple of quarters. In terms of rental escalations, this is what has happened over the past 5 years, up until the end, 5-6 years, up until the end of 2015, a downward trend here in rental escalations. This is very low, 3.2%, extremely low. But one must take into account it's the national average for all types of properties. But one can see here on a regional basis again, what has happened in the past, recent past 4 quarters of last year. And in all 3 provinces, there was a downward trend in rental escalations. Now, if one takes into account the provinces, one must just, I will refer to some metro areas, and I've referred to metro areas in terms of price trends. Although it is focusing on a province, on a provincial level, one must take into account that your metro areas and these provinces are the major driving factors. So what you see here is most probably a reflection of what is happening in the big metro areas in these provinces. These are just the rental levels. Cape Town or Western Cape, relatively high, but interesting, the Northern Cape is the most expensive province in the country in terms of levels of rentals. They're sitting at about 7,700, 7,800 per month in the 4th quarter of last. Now, why is that? They don't have a major metro area with an influx of people there, but they've got major mining companies. And in small towns like Kathu and Sishan, there are massive mining operations, and those mining operations have expanded and grown massively over the last couple of years, which created a massive shortage of housing. And that is why rentals in that specific province went through the roof. And it is still currently relatively expensive, but that is just on the sideline. So these are the latest trends in terms of rentals. Now, taking into account what has happened with price growth, we know that price growth is not very strong. Rental escalations not very strong either. So what has happened to rental yields? Because that is a reflection of what is happening with those 2 components of rentals and prices. And rental yields have started to level out in this stage here, at this stage, 2008 or 2005, 6, 7, round about there. House price growth was relatively strong. So prices increased at a faster pace than rentals, and obviously your rental yield would have been lower. That situation turned around after the recession. Price growth moved to much lower levels, much slower increase in property values, which caused your rentals to increase. And again here, this situation where rentals have started to level out in a gradual downward trend. I think it's a combination of a lot of pressure on rentals. Rentals are not in a position to increase quite sharply currently because of the economic conditions, but price growth. Property price growth is also relatively low and subdued. So that is a combination. In terms of some metro areas, relatively well balanced, except Cape Town, a little bit out of sync there, much lower. Cape Town is the most expensive city in the country, taking into account Johannesburg as well. Cape Town is the most expensive city for a couple of years, and obviously that will have an impact on your yield calculation. So what is quite interesting, taking it a little bit further, is in terms of title deed. What is the difference between sectional title and full title? And your sectional titles, much better performance. Again, in terms of full title comparison there, on average your sectional title property will be a cheaper type of property, but also a strong demand for that type of property. So in the end, your rental yields relatively good there, around about 9%, in some instances just below 9%. But on the full title side, less than what we see in the sectional title side. And the more expensive the full title property, the lower the yield. So again, what does that tell you? Focus on where there's a strong demand for rental property. It's fine to say I own a rental property of 3.5 million or 5 million, whatever, in the posh area, and I can afford to have a rental or an investment property there. But look at the yields. One has to take these issues into account. You still want a good return on your investment. And this is quite interesting. And I believe it is because of the prices of full title properties. And obviously also the rentals. You know, rentals of a full title property will most probably, or a big house will be much more than for a sectional title flat or townhouse. Quite interesting trends coming from these. Then a last segment is the student environment. You know, Cape Town, Johannesburg, Pretoria, and some other areas in the country, more smaller towns, have universities, and the student numbers have increased massively over the last couple of years. And it seems like that only 10% of first-year students can be accommodated in university accommodation. And I think we all know that. We've seen in recent times what has happened at certain university campuses in terms for the demand for wanting to study, but also the demand for housing going with that. So TPN student accommodation research shows, well, it was done in mid last year, that it is fine to get involved in that, but where a parent of a student is involved, the experience from an investor point of view is just much better. Higher level of rent, good standing, 94% compared to only 77% where only a student is involved in signing that lease, and the length of leases. So they chop and change quite quickly, want to move on. So quite interesting, but student housing, I believe, is definitely a strong focus that any investor should also have if he can get into that space. Obviously, there are various factors that will play a role in those areas where there are universities. You know, if your investment property is too far from campus, the student will need his own transport, all of that. So those things will definitely also play a role in terms of investment in student housing. But quite interesting developments here. And this demand will not go away. It's a structural feature of these cities or towns. The university will be there in 10, 15 years, 20 years' time. They won't disappear next year or whatever. They will still be there, and they will grow. So the student numbers will increase, and the demand for student housing will also increase together with that. So in terms, just as a summary, key residential property market factors, 4 levels, I believe: the economic factors, the consumer factors, the finance factors, from a property finance perspective, and affordability. Affordability has become much more important than in previous years, not only from the point of view of affording to buy the property in terms of the price of the property, or being able to service that mortgage loan on a monthly basis, but also running costs, operating costs, your rates and taxes, electricity, water, all of that. has become much more important in recent times. So from a broad macro perspective, I believe these are some of the most important factors, these 4 categories of factors that, that one should take into account when looking at property. Not only investing, but also for primary purposes. So the last slide there, what are the important factors I believe one should look at and keep in mind when investing in property? Economic cycle, your property cycle, what is your investment horizon? And that can change against the background of what is happening in these 2 cycles. Cycles go up and down, and so your investment horizon will have to adjust to that, because sometimes your capital appreciation will be strong and you can invest for a short period of time, as we've seen in the past. But I believe currently it is not the case. I believe 5 years plus at this stage. Location will always remain one of the most important factors. For example, student housing. It is no use to have a student flat in where is it? In Limpopo, wherever. Let's say Tele, there in the Lowveld, very nice area to live there, but you can't have student housing there. It must be near the university. Property returns, your yields, your income return, capital appreciation, those factors are important. But you should most probably have a different view there. Sometimes the capital appreciation will be slow. You will have to have a longer investment horizon while you are still earning a sizable income on a monthly basis. So those are 2 views in terms of property returns or yields. The purpose of the property. Why do you want the property for? What is the reason? And are you in it for a long term, short term, whatever? And it is always good to try and diversify in terms of your property type and area. You can have a flat near university for students, but you can have a flat on the north coast of KZN for leisure purposes, using it yourself, but also during peak times you can rent that property out. But then you must remember that type of property is very seasonal. There will be times that property is then not rented out, and that can have an impact. But obviously, one normally knows that. Tax implications, and obviously your costs in the end, in terms of owning property. So not for everybody, but most probably a longer term type of investment currently than what we've seen in recent years. But I believe quite a number of factors that one should keep in mind. Economic cycle, the consumer cycle, all of that. Because the consumer will come to you and say, I want to rent your property. But if your property is out of line in terms of market trends or whatever, you will be finding it difficult to rent out that property. So it is important to take account of the macro trends and try to determine the impact of those trends on your client. And obviously these are much more personal stuff, nothing to do with your client, but from an investor point of view, I believe those factors are also very much important. So that is all from my side. Thank you very much for your time. I appreciate it. Most probably spoke for much too long. Thank you.